Good morning, all of you. Is my voice very clear?
Good morning, sir.
Good morning, all of you. Then I think how many of you? 33, 34 participants. Right. So we are going to start a new chapter, chapter 3, valuation of bonds and shares. Valuation of bonds and shares. And learning objectives of today's session. First, explain the fundamental characteristics of ordinary shares, preference shares, and bonds. Sometimes we call as debentures. And show the use of present value concepts in the valuation of shares and bonds, and learn about linkage between the share values, earnings, and dividends, and forecast rate of return on the share, and finally focus on uses and misuses of a price earning ratio. So these are the learning objectives of today's session. So, right. Let us we'll go through introduction. In surface level, we have to focus mainly on calculations, right? Right. So before that, before enter into the calculations, we have to have clear ideas about each and every basic concepts. We have to have a clear idea on clear understanding on the basic concepts and practices in the financial market. And also we have to have a clear idea about the financial instrument, especially what is shares, what what is preference shares, what are the difference between preference share and ordinary share, and bond and debentures, right? Assets assets can be real or financial, real assets or financial assets. Securities like shares and bonds are called financial assets, right? If you purchase shares in of a company, so that's an example for financial assets. If you deposit a sum of money into the bank, so you will receive a certificate, so that also as a financial asset. And if you have a check, right, a check, that also kind of financial assets. While physical assets like plant machineries are called real assets. Further, for the examples, we can say if we have a vehicle or car and a land, building, houses, so any other things called the real assets. If you have in your pocket, you have a note, rupee note, it's financial assets, right? The concepts of risk and return as determinants of values, right, are the fundamental and valid to the valuation of securities to that of physical assets, right? In the first chapter, we have discussed the basic idea about risk and return. Right? Risk are the uncertainty, right? Risk consists of uncertainties, risk, right? And return is a profit. And yeah, the concept of return and risk as determinants of value are as fundamental and valid to the valuation of securities as to that of physical assets. So, so why we want value an asset, like physical assets? When you buy a car, right? when you buy a car, you have to have a clear idea about market prices, the value of that asset, the land or the building, isn't it? Likewise, um, you know that the ordinary shares and bond and preference shares are the examples for the financial assets. So it can be tradable, right? You can buy and you can sell, right? The so for that, due to the transaction, buy and selling transaction, you are expected to have a return, profit, right? Profit. The profit, the profit is wholly depends on the valuation, correct valuation, right? So when you will buy an asset in the market, you compare both market price and the actual price. If the market price is higher than the actual price, the implicit price, then you will buy, right? You will buy and you can sell it for, you can resell it, the share for the higher price in the market. Then you will get profit. Likewise, if the market price is high, if the market price is low, but the actual selling price or buying selling market, yeah, the market price is low, the actual price is high. So what do you do? How you can make profit? The market price is low, but you can sell that share in a high price. So you buy the share, the market, you compare the market price and the actual price, right? If the actual price is high than market price, you better to sell it, right? Yeah. Right, the efficient capital market. So there are three forms of capital market. Efficient capital market implies a well-informed, properly functioning capital market. There are three types of efficient market: a weak form of efficient market, semi-strong form of efficient market, strong form of efficient market. Right? So this categories is based on the informations. Right? It implies a well-informed, properly functioning capital market. Right? It's actually when you value, when you decide whether to buy shares or sell shares, you have to compare the market price and implicit price, right? Market price and implicit price, you have to compare market price and implicit price, not actual price, right? So we don't have that kind of price in finance management. There are prices, uh, book value, implicit value, market price, so that sort of things we will discuss in detail, right? Here, the book value. So book value, it's not a new concept for you since you all of you are accounting students. Just recall the concept. The book value. The book value per share is determined as net worth divided by number of shares outstanding. Book value reflects the historical cost rather than value. So in simple terms, when you take a balance sheet statement of financial position, right? What you do is you can find net assets. Net asset. How do you find net assets? So you have to you have to take the total value of assets minus external liabilities. Then the balance figure equal to net assets, net worth, and you divide the net worth, net assets by number of shares. Then you will get the value of the value per share in terms of book value. The book value reflects a book value reflect historical cost rather than the rather than value. So the book value is not reflect the market price, right? Not, the book value is not reflect current price in the market. Rather, it reflects historical value. And the replacement value, replacement. So you have an old asset, you have to replace the asset using the new assets, right? So that's called replacement value. Replacement value is the amount that a company would be required to spend if it were to replace its existing assets in the current condition. So you have old assets, say for example 1 million, the old assets, existing asset. So the existing asset is outdated one. So you want to replace the asset by new assets, new machine. So that machine cost is 1.5 million, 1.5 million, and you can sell the old asset for 0.5 million. Then what's the replacement value here? So replacement value means simply the amount you are required to spend to replace, right? You have to. So what is the value we have to spend additionally? So that is called replacement value. And liquidation value, liquidation, right? If you decided to hold it out, you can find here the face value. How much face value? Face value, how much? 1000, right? 1000 face value is 1000. And what is the rate of interest? Rate of interest, yeah, 8 point, yeah, good. Pavitra says correct answer. Is due maturity on 1983. It's old bond. Right now, all bonds are digital. So this is the example of bond. And I can find another bond example. Sword company. So for this, how much face value of this bond? 100. Yeah, 100. Face value of the no, no, this is not bond, right? This is not a bond. This is a common stock. Ordinary share, right? This is a ordinary share. So which company has issued this bond? It's not a bond. It's a ordinary share, right? If anybody didn't see the ordinary share, so this is the example for ordinary share, common stock, right? And which company has issued this bond in this stock? Which company? Foxborough Company. Good. Yes, Foxborough Company. And so what's the issue date?
Foxborough Company.
Yeah, issue date on May 7th, 1971. Issued company. Issued date. And can you find interest rate on this? Can you find interest rate? Yes or no? You see, are there any interest rate? No, no, good, because it's a common stock, ordinary share. Ordinary share doesn't have any rights to getting dividend. So, no, sorry, not interest. Right? If the company generate profit, then they can get interest, so dividend. The company earn more profit, then they are right to have receive dividend. Okay, so this is the common stock. So I can save this image. So this is example for bond, and we can find, and yeah. So this is bond or stock. This one, it's bond or stock. It's a bond. Good. What's the face value? Par value? How much? Par value? 5,000. Good. 5,000. What's the rate of interest? Rate of interest? Yes. Good. And due date? Due date? Yes. January. January 1st, 1990. January 1st. And yeah. So this is the example for, and which company? Should company? Should company? Which company has issued this bond? Ford Motors. Ford Motor Company, right? The Ford car. Yes, Ford Motors. And issue date? Issue date when? When the issue date? Issue date is June, no? June 1973. Yes, June 12. Good. Who says? Pavitra exactly says. Pavitra Jayavir says exactly. June 12th of 1973. And how many years? The maturity period, how many years? Maturity? We can redeem this bond on 19th, first of, not first of, 15th, 15th January. 15th January 1990. Issued date on June 12th of 1973. Yes, 17 years bond. Right. So we have a good knowledge on what company. This is a common stock, I think. This is registered $1,000. It's a bond. It's a bond. Wait, cancelled. This is common stock. Right. So we will, good. Sajid Dilshan. Yeah, correct answer. 17 years. So, yeah, good. And right. and a bond indentures, contract between the company and the bondholders, right? So company issuing bond for the purpose of raising fund from the public as debt, loan. So this is an agreement between the company and bondholders. If you have purchased that bond, then you are the bondholder, right? The contract includes the basic terms of the bond, and the total amount of the bond issued, a description of property issued as security, if applicable, sinking fund provisions, and call provisions, detailed productive covenants. So you can read and understand if you want more detail, and types of bond. So it's very important, right? It is very important to approaching the calculation of valuation of bond. Calculate value of the bond. Bond with maturity. There are three types of bond. First one, the bond with maturity, right? Bond with maturity. Then you can find there is a coupon rate and there is a maturity, right? There should be a maturity. That is number one. Number two, pure discount bond. Pure discount. What do you mean by pure discount bond? Pure discount bond mean there is no rate of interest. There is no coupon rate on this bond, and it has a maturity value. So what is the profit for the bondholder? Right, the normal bond has what? The coupon rate and maturity period, but a pure discount bond, it doesn't have any coupon rate or interest rate. So my question is, what is the profit return for the bondholder? Any idea from your side? Any idea from your side? Right, the pure discount bond means, say for example, the par value is 1000. Par value is rupees 1000, and there's no interest rate for the two, but and at the time of, say for example, the par value is 1000, and you can buy the bond at the price lower than face value in the market. Say you can buy the 1000 value bond for rupees 300 rupees. Right? Today you buy the bond for 300 rupees, and you keep that bond until maturity period, say 5 years. After 5 years, you can submit the bond to the company, and you can get 1000. So what's the profit? Here is 1000 rupees is the face value. So you can get 1000 rupees. You have purchased that bond for 300 rupees. The difference is 700. This 700 is a profit for the bond holder. So for this bond, you cannot find any rate of interest. And next one, so perpetual bond. Perpetual. What do you mean by perpetual? I explained the last class. I have explained in the last class. What is perpetual means? Perpetual means forever. Forever. There is no maturity. There is no maturity for that bond. For the lifetime, get you can get interest from that bond. So uh, in that bond, you can find maturity. You can find coupon rate, interest rate. You can find the face value, but you can't find maturity period. Right? You can't find maturity period. And any questions? Any questions in understand in types of bond?
Sir, tell again one time, sir.
I can write. Yeah, the first type of bond is it's come up with coupon rate. Coupon rate means interest rate, right? Plus maturity period. Maturity period. There's a expire date for that, right? You can find coupon rate as well as maturity period. Say for example, 1,000 rupees, 1,000 rupees face value bond. It mature after 10 years. For the 10 year, you can get 10% or 12% interest, right? For this bond, you can find both maturity period as well as the coupon rate. Second type of bond is a pure discount bond. Pure discount bond. Pure discount bond. You can find the face value, say for example 1,000 rupees. It has maturity period. You can redeem your money after 10 years, but you can't find any rate of interest. That's no there's no interest on that bond. Then how you can make profit? By having pure discount bond. Say you know that the face value is 1,000 rupees now. 1,000 rupees face value. You can buy this security at, for example, 300. It means your investment is 300. Your investment is 300. So then you buy the bond for 300 rupees, and you keep the bond for 10 years, and you will get 1,000 rupees after 10 years, right? You purchase that bond for 300 rupees, and you keep that bond for 10 years. After 10 years, you submit the bond to the company, issued company, and you will get 1,000 rupees. So therefore, your return is 1,000 rupees minus 300 equals 700 rupees is the return for 10 years, right? 10 years. For 10 years, you can get 700 rupees. And third type of bond is perpetual bond. Perpetual bond. So, for example, the face value of the bond is 1,000. Face value of the bond is 1,000, and the rate of interest is 12%. And you can't find maturity period. Right? You can't find maturity period. It's infinitive, forever, right? You just purchase the bond for 1,000 rupees, and the company will pay 12%, 120 rupees every year as interest forever. There's no end for that interest. All the times, all the year until you die, you can get interest. But the thing is, you can't demand this thing. There's no maturity, no. So you can't take your investment, but you can get your interest as return for the uh, yeah, as return for your investment, right? Clear? Clear? For the calculation, it is very
Yes, sir.
important, right? So there are formulas. These formulas are differ for these three types of bond. So before you apply the formula to calculate the value of the bond, you have to clearly understand the bond what type of bond is. Otherwise, you will apply a wrong formula. Right. Now we will move to how to calculate value of the bond with maturity. It means the first type of a bond. Right? Bond value equals is the formula present value of interest. So already we have discussed what is present value, right? So if you buy the bond today, if it is a 10 years bond, you will get interest for the next 10 years, right? End of every year for 10 years, plus present value of maturity value. So when you will get maturity value from that bond, if the bond is 10 years bond, if it matures for after 10 years, so when you will get that interest, that investment on that bond. Say right, it's a bond, no? Yes, good. Santamar says, Fatima Niswa says, correct answer, right? It's a bond. How many years bond? So 17 years bond. Today, you purchased the bond for 4,500 or 6,000 or so. That's market price, right? That's a market price. You purchase the bond. Face value of the bond is 5,000. You keep this bond for 17 years. Say, for example, today date is 1973. Today you have purchased this bond. It issued by Ford Motor Company, right? The face value is 5,000. Face value is 1,000. So the Ford company is a very reputed company in the US market. Therefore, the market price of the bond is 5,800, right? The market price of the bond is 5,800 today. And you keep the bond with you, right? And you will take interest. You will get interest. How much interest you will get interest for this bond? If you keep this bond, how much per year? How much you will get as interest? Your investment is 5,000. Face value is 5,000. Yeah, so you have to calculate interest on this value, on this face value, not your purchase price. You have to calculate interest on its face value. So in this example, face value is 5,000. Coupon rate or interest rate is 8.8108%. So what is the rate of interest? So what is the interest you will receive? How much? Anybody of you? Please find how much interest you will receive per year. Please do the calculation. Yeah, Isuru says 471.25. Any others? Any others? So this kind of understanding is very important for the valuation of bonds, right? And can you find the so, common stock? Yes. For this, how much? So your BP Trans Alaska Pipeline Finance INC. So face value is 1,000. Face value is 1,000. Market value may be 1,100 or 1,200 or 900 or 950, whatsoever the amount in the market. So you have to find uh, interest on its face value. How much for this bond? Please respond quickly. No, face value 5,800. No, face value is 5,000. So right. So forget about the interest. And now we have reached this date, due date. Now the date is January 15th, 1990. Now it means assume that you have kept this stock for 17 years, and you all the period you have taken interest from the Ford Motor Company. Then now is the time to redeem your investment. Then simply you just go to Ford Motor Company and you submit this certificate to them. They will give you how much? How much? 5,000. Simply 5,000. If you submit this bond to the company will give you 5,000. That is called uh, maturity value. Most of the time, maturity value is equal to its face value, right? Most of the time. If not, they will give the detail of that uh, maturity value, right? Depends on right. We got clear idea. Shall we move to the calculations? So if you any gray area, if you have any gray area, please. I think you didn't see the screen, right? Right. Shall we move to the calculation? Right. Yeah. The value of the bond B naught. Value of the bond B naught. B naught means the value of the bond equals sum. Sum is total of interest. Interest for the every period. Interest and 1 plus KD plus B naught. So not BN. The bond maturity value, right? Maturity value and 1 plus KD N, right? In simple terms, I will show you a simple way of calculating uh, calculating uh, right, simple value for calculating the bond. So B naught is the value of the bond today, right? Value of the bond today, sum of interest, interest at time t. So if it is 10 years bond, you will get interest for 10 years, year 1, year 2, year 3, year 4, like that. And you have to convert this interest into present value. That's why we have to put 1 plus KD. KD means cost of debt. Cost of debt. So discounting factor, right? 1 plus KD. KD means cost of debt into for the period. And B is the bond value, maturity value of the bond in over. We have to convert this maturity value into present value. Right. I will show you a simple way to calculate the value of the bond. Right. Example. Please read the example. Please read this example and get an idea. Compare this example with your formula. Okay,